A. Identify issues related to the valuation of accounts receivable, including timing of recognition and estimation of the allowance for credit losses. Accounts receivable are recognized when revenue is earned, not when cash is collected. Under accrual accounting, receivables arise at the point control of goods or services transfers to the customer. The timing of recognition affects both revenue and asset valuation. If revenue is recognized too early, receivables and net income may be overstated. Proper cutoff procedures ensure that receivables reflect valid claims existing at the balance sheet date. Receivables are reported at net realizable value. This amount equals gross accounts receivable minus the allowance for credit losses. Because some customers will not pay, companies must estimate expected uncollectible amounts. This valuation approach reflects the economic reality that not all recorded receivables will convert into cash and ensures compliance with faithful representation and conservatism principles. The allowance for credit losses requires judgment and estimation. Common estimation methods include percentage of sales and aging of receivables approaches. The aging method applies higher default percentages to older balances, producing a more precise estimate of ending net realizable value. Changes in economic conditions, customer credit quality, or collection history may require adjustments. The offsetting bad debt expense affects net income, reinforcing the matching principle. Write-offs and recoveries affect the allowance but not net income at the time of write-off. When a specific account is deemed uncollectible, it is removed from accounts receivable and the allowance account. This write-off does not create additional expense if previously estimated. If a previously written-off account is recovered, both receivables and allowance are reinstated before cash collection. This approach maintains consistent valuation without distorting current earnings. B. Distinguish between receivables sold, factoring, on a with-recourse basis and those sold on a without-recourse basis, and determine the effect on the balance sheet. Factoring without recourse transfers credit risk to the factor. In a without-recourse sale, the buyer, factor, assumes the risk of customer non-payment. If the transfer meets GAAP sale criteria, the receivables are removed from the balance sheet, and any gain or loss on sale is recognized. The company no longer records an allowance for those receivables because the risk has been transferred. This treatment improves liquidity ratios but may reduce future collection upside. Factoring with recourse retains some credit risk. In a with-recourse arrangement, the seller guarantees payment to the factor if customers default. Even if derecognition criteria are met, a recourse liability must be recorded for the estimated obligation. This liability reflects continuing exposure to credit risk. The balance sheet shows reduced receivables but includes a new liability, partially offsetting the liquidity benefit. If sale criteria are not met, the transaction is treated as a secured borrowing. Receivables remain on the balance sheet, and cash received is recorded as a liability. The company continues to recognize bad debt expense and maintain the allowance account. This treatment increases both assets and liabilities and affects leverage ratios. Proper classification depends on whether control and risk have truly been transferred under U.S. GAAP standards. C. Identify issues in inventory valuation, goods included, cost assumption. Inventory must include all goods owned at the balance sheet date. This includes goods on hand, goods in transit, depending on FOB shipping point or FOB destination terms, and consigned goods if ownership remains with the consignor. Proper cutoff is critical to avoid overstating or understating inventory and cost of goods sold, COGS. Errors in ownership determination directly affect gross profit and working capital. Inventory cost includes all expenditures necessary to bring goods to saleable condition. These costs typically include purchase price, freight in, handling, direct labor, and manufacturing overhead. Selling costs and abnormal waste are excluded. For manufacturers, product costs include direct materials, direct labor, and allocated overhead. Accurate cost capitalization ensures compliance with matching and faithful representation principles. A cost flow assumption must be selected to assign costs to ending inventory and COGS. Acceptable methods include specific identification, FIFO, LIFO, and weighted average. The chosen assumption does not need to match physical flow but must be applied consistently. The selection affects reported income, taxes, and asset valuation, especially during periods of changing prices. D. Identify and compare cost flow assumptions used in accounting for inventories. FIFO, first in, first out, assumes earliest costs are expensed first. Ending inventory reflects the most recent purchase costs, making the balance sheet more current. In periods of rising prices, FIFO results in lower COGS and higher net income. However, it may increase tax liability due to higher reported profits. LIFO, last in, first out, assumes the most recent costs are expensed first. COGS reflects current replacement costs, improving income statement matching. In inflationary periods, LIFO produces higher COGS and lower net income, reducing taxable income. However, ending inventory may be significantly understated relative to current replacement cost. Weighted average smooths price fluctuations. It assigns an average cost per unit to both COGS and ending inventory. This method reduces income volatility compared to FIFO or LIFO and is simple to apply. Specific identification, used when items are unique and high value, matches actual cost to each item sold. Understand lower of cost or market, LCM, for LIFO and retail, and lower of cost and net realizable value, LCNRV, for others. For FIFO and weighted average, inventory is valued at the lower of cost and net realizable value, NRV. NRV equals estimated selling price minus costs of completion and disposal. If NRV falls below cost, inventory is written down, and a loss is recognized. This rule prevents overstatement of assets and income. For LIFO and the retail inventory method, the lower of cost or market, LCM, rule applies. Market generally refers to replacement cost, constrained by a ceiling, NRV, and a floor, NRV minus normal profit margin. This three-tier constraint ensures inventory is neither overstated nor understated excessively. Inventory write-downs affect both income and assets. When market or NRV falls below cost, COGS increases and net income decreases. The inventory asset balance declines accordingly. These rules reflect conservatism and protect users from inflated asset valuations.